Hello, this is Mike Swanson of WallStreetWindow.com. I've got a very special guest with me today. I'm speaking with Ike Iossif, who runs the website MarketViews.tv, and this is a follow-up interview to an interview we did earlier a week ago. So this is part two. If you want part one, I got a link to that below this video. How are you doing today, Ike?
I'm doing well, Mike. Thank you. How about you?
Oh, I'm doing great. This has been a very interesting week. I got to tell you, I got a lot of emails. People want to buy things, and they're mesmerized by the action in various markets this week. But I think it's useful to step back and really look at the big picture because it's so easily missed. And I think your presentation here may be the most important market in charts for us to even look at the entire year.
Well, thank you. Well, Mike, we need to go back a year ago. And in fact, we need to go back to January 15th of 2018. We did an interview report on that date. And at that time, I had said that the purpose of the report was to highlight and raise awareness of the important issues, questions with which intermediate and long-term investors ought to be asking at the beginning of 2018. So for that purpose, we look at some key long-term charts going back to 1980. Interest rates represent the cost of money. The cost of money affects the pricing of all assets to a greater or lesser degree. Now, the yield on the 10-year U.S. Treasury is a bellwether for global interest rates, cost of money, so we focus extensively on it. At the time, I had pointed out that if you look at the long-term charts, undisputably, equities had been the biggest beneficiary of low interest rates. And I had pointed out, and that is the second chart, that going back to 1980, every time the yield on the 10-year got up to the declining top line, we had either a sharp market decline or an outright bear market. And the second chart is the chart that we posted a year ago. Now, the third chart shows what happened in 2018.
Oh, okay.
And as you can see very clearly, and I believe our viewers, what happened? The yield got up to the declining top line, and the market had a 20% decline. Okay? Looking at this chart, there are 3 points that we need to make. The one I just did, okay? The second, and that is very important too, declining bond yields because of economic slowdowns do not help equity prices. And you can see that, for example, during the 2000-2003 bear market, yields declined 50%. The equity markets declined 50% as well. And then during the 2008-2009 bear market, yields declined 60%. The market still declined 50%.
Yeah.
So this is a point that investors need to keep in mind. If interest rates are coming down because of an upcoming recession, that's not good for the stock market. Okay. The third point we also need to make is this. From 2016 to 2018, the yield rose 256%, from 1.36 to 3.24. In the same period, the S&P gained 47%. It went from 1990 to 240 at its top in September. Okay? So, right here we can see, again, I'll summarize it, 3 things. One, when yields rise up to the declining top line, the past 30 years we have had a decline in the market. 2, if the decline in yields is associated with the Fed lowering rates because of a recession, that does not help the market. And 3, in a rising yield environment, if if corporate profits are rising, then the market can withstand that rise as long as secularly yields are down. The red line, which represents the secular trend, is very important. One can say, well, gee, look, my God, yields rose 256%, the market rose 40%. Does that
Let's
mean,
get another rise.
well, yeah, I mean, does that mean if yields go from 2.5% to 5%, the market's going to rise another 40%? No. The difference would be this. If we break above 3.2%, that means the secular trend has changed. It's easy for people to oversimplify things and look
Because we're
at,
breaking the trend line. That's the
yeah,
second
exactly,
trend.
okay? And what the previous chart, the one we showed last year, is telling us is what? That the markets, the equity markets, have benefited tremendously from a secular downtrend in yield from 1982 until now. So that is why every time we got up the declining tops line and there was a possibility that the secular trend will change, the markets stood a fit. So the next thing we want to do is take a look where we at now, which is our next chart. Now, our next chart, okay, which is the monthly chart, shows that since 2017, the monthly trend is up. It's in a rising channel. The upper channel resistance is at 3.2%. The lower channel resistance is at 2.5%. Okay, so this is where we are now. As a chartist, I look at the chart and I'm thinking to myself, okay, what is this chart telling me? Based on this, what are the probable chart scenarios? And that is where the trouble comes. Last year, there was one or two scenarios, and the most probable was the one for the rates to rise up the declining tops line. And we explained that in detail last year. People can listen to the interview and understand why. But now, looking forward, there are many probable scenarios. So the real risk in the market comes from the fact that you have many different outcomes that could take place. And I'm showing all of them. And now this is not a forecast. As a chartist, I look at the chart and I'm telling you this chart can develop into the next 5. The first one is chart 1, or like the 2.5 level holds, and then we get the further rise up to the upper end of the channel, which is roughly at about 3.5, 4%, and that will break the decline tops line. Another outcome, which is number 2, and that is we get a decline back down to the 2012 and 2016 lows. For that scenario to take place, that means we will have to have a recession sometime in 2019, late 2019, early 2020. In that case, I don't think that will help the stock market. Third scenario.
Because historically, as you already showed, when the rates have fallen, the stock market's fallen. That's what happened in 2008. That's what happened in 2000, 2002.
If rates are falling because the Fed is lowering rates because of the recession, that's what happens, okay?
Yeah.
So then we got the third scenario. That is, we get a false break below 2.5%, and then we get a break above 3.2%. That's scenario 3.
Okay.
Scenario 4, which is actually the most bullish for the stock market, is for bonds to go sideways for the next 6 to 9 months. And that would be the most bullish scenario for the stock market.
Do you think that's what the Fed is trying to do?
I think that is what it's trying to do. Whether it is successful or not, that's something we do not know.
Yeah.
But there are other factors that will play into this. I'm going to talk about them in a few minutes.
Mm-hmm.
And then the next scenario, the most bearish, is that we do get a decline back down to 2.22%, but that decline is a part of a bigger W bottom that is taking place from 2006 until now. In that case, rates can rise up to 6%. Now, one would say, my God, this is crazy. Yes, it is, but we have seen the market doing crazy things before. Again, this is not a forecast. What I'm saying is, as a chartist, I look at the first chart, okay, and I'm thinking, okay, how this chart could develop. It could play out in 5 different ways, and that is the risk. You don't have 1 or 2 scenarios. You have 5 here, and when you have 5, it's very tough to control risk.
Well, people need to print this out and keep it with them for the rest of this year, because I hope number 4 happens. I want number 4 to happen. I want everyone to be able to easily just sit there and make money. But number 5 is a possibility. What if people start to get scared of the $1 trillion deficits the government's creating? I mean, who knows? Or some other factors. Who knows, you know?
Well, the thing is, you have 5 outcomes, okay? And out of the 5, only one, number 4, is bullish for the market. The other 4 are from bearish to very bearish. Okay? Because I said, if we break below 2%, that means we're going to a recession. That will be bearish for the market.
Well,
If we break above 3.2%, that means the secular downtrend is over. That will be bearish for the market. Okay? So you have 5 different scenarios.
Yeah.
One of them is outright bullish. The other of them vary from bearish to very bearish. But I wish I could say the most bullish scenario has a 40% probability.
Yeah, I like that.
You can't say that. At this point, there are many different moving parts. Therefore, you can't say that. And I wish I could say the most bearish scenario has only a 5% probability. I cannot say that either. I mean, based on the tools that I use, I cannot give you a probability that has statistical significance, okay? And that is one of the problems going forward. Now, anybody who tells you he knows what's going to happen, I think they can find themselves in real trouble. What you need to know for 2019 is that there are many moving parts. And because there are many moving parts, the best way to control risk is to have small positions and not have too many strong convictions, but to be open-minded and change. Now, there's a couple of other things that I'm going to point out, okay? The problem here, one of the problem areas is valuations. Now, valuation is not a timing tool. It just gives you an idea of the overall climate. But the thing is this, based on the data that we have until January 19th, just 2 weeks ago, and the market was lower than where it's at now, valuations were just 10% of the highest level in market history. So one question that investors need to ask themselves, I'm asking this question myself, is this. If interest rates continue to go lower because at the end of 2019 there's a recession coming, and at the same time we have record high valuations, how is that going to help the market? I don't think it's going to.
No.
Okay? So I want to warn people about the trap of lower interest rates is good for the market. You have to look at the big picture. Look, from 2016 to 2018, rates rose 250%. the market still went up 40%. Okay? So in 2000, 2002, 2008, 2009, interest rates were down by 56%. The market still lost 50%. So if interest rates go much lower than 2.2, 2%, I don't think this is going to be good for the market. Actually, the best that can happen for equities is for rates to move sideways for the rest of the year. The last thing I want to point out is this. I have on the last chart the Ncp earnings by year. For 2018, we only go up to the third quarter because the fourth quarter earnings are not all in yet. And then next to it, I have the gains for the market. Now, when you look at 2015, where earnings were at December 31st, 2014, and where they were at December 31st, 2015, during 2015, earnings were down 16.3%. The market during that year lost 5%. Then the next year, earnings rose 7%. The market was up 18%. The following year, 2017, earnings were up 13.8%. The market was up 22.63%. If you look at these 2 years, the gains in the markets outpaced actual corporate earnings. Okay? So, here we go in 2018. Earnings are up 16% and the market was down 7.3%. Why? Well, it had already discounted regular earnings the previous 2 years. So although earnings did go up, the market went down. And that brings me to my next and last point. If 2019 turns out to be a year that we see lower earnings because 2018 was a peak earnings year, how is that going to affect the market? I have an idea, but to be safe, I would say I do not know. And I have a reason for saying that, not to avoid the answer, but to highlight to the people who are listening to us that this is another unknown factor for 2019. So when you put it all together, okay, I think interest rates may be stable for the first half of the year, but the second half could pose surprises. And on top of this, we have other moving parts, a slowdown in earnings and a slowdown in Europe. With the data that was released today, we know that Italy has entered recession for a fact because it has had 2 quarters of declining GDP growth. So Italy is officially in a recession. We know German economic growth has slowed down. So there are several factors that I said are pose a risk for the market in 2019. In 2018 was much easier to identify where the danger was. It was from yields rising up to the declining caps line. It happened, the market lost 20%. Now what?
Well, a year in June of last year, the global yield curve inverted, and that's the most accurate indicator of a global recession, and it looks like it's hitting Italy first.
Well, it's hitting the...
Well, Turkey, of course. I mean, it's hitting pockets of the world.
It's hitting the weakest countries first.
Yeah.
Okay?
Egypt, Turkey, Greece, so forth. And, well, I don't know, Greece. I don't know. You're in Greece. Is there still a recession in Greece?
No, it's not, but there's no growth either. In fact, based on the economic reports that were released this week, the economic climate deteriorated for the 5th consecutive month in Greece. Again, the point, Mike, that people need to keep in mind, and this is the second interview we're doing this year, and I'm actually, I'm suggesting the same thing from a different angle, and that is 2019 could be the year that holds lots of surprises, both on the downside and on the upside. The key thing is, because unlike 2019, when there was only one moving part, interest rates, in 2019 we have several moving parts. The only way to control risk is have small positions, don't have very many strong convictions that can get you in trouble, prepare to be wrong, change your mind, change your position. That's the bottom line. And I think the charts we posted and this week and last week support that.
Oh, and it's what I'm doing personally. I think it's the best advice we can give people because, I have cash reserves at the moment in all my accounts. And just this presentation with, your charts of the bonds, these are potential secular trends. These aren't like day trades that could line up, but things that might last for a very, very long time. And I don't know what direction interest rates are going to be going at in the fall, but I potentially do want to trade it, but I don't know how I would do it at the moment. So I got to really watch it and I don't have a position one way or the other with bonds. So I just want to watch it. And watching makes it easier to be objective on where things are going too. If you're fully invested, it's hard to be objective in the markets. It just is. If you're 100% in something and it's declining, you want to believe it's going to turn around until it's too late.
Well, look, there's a time to be fully invested, and there's a time to have small positions. Now, my point is, when you have so many moving parts as we do now in 2019, I believe the key thing is to have small positions. That's it.
Yeah, I 100% agree. Well, and we'll be on top of how this evolves as the year goes through. Thanks for taking the time to talk with me. And anyone who wants to get more of your information, I recommend they go to your website, marketviews.tv, and sign up.
Mike, thank you. Have a great day.
Thank you, Ike.